Good morning, everyone. I'm Bridget Polachine, CEO of the Institute of International Bankers, and I'm happy to help to welcome everyone to today's webinar, exploring what actions bank regulators may take as they address the financial risks posed by climate change and what banks should be doing to prepare. This webinar is especially timely given the ongoing discussions at COP26, and one of our panelists will be reporting directly from COP26. The recent FSOC report on climate-related financial risk and the announcement last week by Acting Comptroller of the Currency, Michael Hsu, that he plans to develop climate risk management supervisory expectations for large banks and issue framework guidance for comment by the end of the year. I want to thank Jonathan Schindler and Aaron Schreier from Cushman Wakefield, an IIB Gold member, and Scott Giberson from CoreLogic for arranging this webinar. We have an incredible lineup of speakers today, and I want to encourage members to submit questions. Let's take advantage of the expertise on the screen. You can use the Q&A function on Zoom, or for those of you participating by phone, feel free to send an email to info@iib.org. Joining us today are Rob Engel, Nobel Laureate and Professor Emeritus at NYU's Stern School of Business. Rob is a co-author of a recent staff paper by the Federal Reserve Bank of New York that proposed a stress testing procedure to test the resilience of financial institutions to climate-related risks. I know we'll be interested in learning more about that. We also have David Mordecai, who leads research activities at the Risk Econ Lab for Decision Metrics at NYU's Courant Institute of Mathematical Sciences. Peter Carroll, who oversees industry and public sector engagement programs and drives enterprise strategic initiatives for CoreLogic, a leader in providing financial and property analytics and business intelligence. Chris Bennett, Global Head of ESG Strategy and M&A for S&P Global, providing ESG data, analytics, and research to help companies make sustainable decisions. Hugh Conroy, a partner in Cleary Gottlieb's financial institutions practice and a familiar face and voice to IIB members. And finally, our moderator, David Risden, who heads banking and regulatory solutions for Cushman Wakefield, a leading global real estate services provider. With that, Dave, I'd like to turn it over to you to moderate our session.
Sure. So each of our panelists will take 5 minutes to focus on the issues and the concerns that they believe are critical. That'll be followed by 10 minutes of open discussion among the panelists, and then Bridget will lead 20 minutes of Q&A. So without further ado, Rob, why don't you get us started?
Great. Well, thanks very much, David. It's great to be with you today. And this is a topic where a great deal of interest and lots of different opinions as to what's the best way to do it. The feature of scenario analysis, of course, is assuming some counterfactual future path of the economy and especially the climate change. What would be the impact on a particular investment, and we're focused on the banks. So the question is, how do you formulate this, and whose scenario is it? So I think one of the big missing parts of the scenario analysis that I've mostly seen is that it doesn't talk about expectations. And it doesn't talk about how investors today view future climate risks. It looks at what the damages are likely to be in the future. But let's take an example of this. Supposing you've got a bank that owns waterfront property. And the sea level is rising a centimeter a year, so it's not a big deal. And you've got 20 years before this is really going to be a problem. Does this mean that the bank doesn't have a risk? Well, the answer is not at all, because what's going to happen is, first of all, the insurance companies are going to stop writing policies on it. And second of all, then the value of the collateral is going to go down. As everybody knows this is actually kind of pretty predictable. And so the property owner is really likely to walk away from this. You're left without collateral and a big mortgage. So expectations really matter in terms of the risk that the banks are going to face. What do you do about that? We have an approach which is actually trying to ask, what are the effects on bank stocks? That is, forward-looking instruments of the profitability of the bank, given the changes that we're seeing in the way the market perceives climate risk. So we get betas on climate risk, and we say, okay, if the market perception of climate risk gets a lot worse, how bad, what's the exposure of the banks to that kind of market risk? We could talk more about that, obviously.
Good. Thanks, Rob. We appreciate that. David, why don't you jump in?
So thank you, first of all, and appreciate being here. And I am honored to be offering some complimentary comments to Rob's comments. It's a great privilege. I've known Rob for a number of years, and very happy to be part of this panel. My background and perspective, I'm focusing beyond the equity markets on commodity credit, supply chain issues, contingent liabilities, and transition risks that, you know, if you're watching wildfires right now and flash floods and inundation of roads, this is not necessarily a 20, 30, 40, 50, or 60-year off thing. We're seeing weather volatility and related risks occurring, today, that science is increasingly, something called attribution science is increasingly creating empirical links between those events in what's called the mesoscale. So between, say, 2 kilometers and 400 kilometers, the kind of weather volatility that's coming up and will impair, say, the trucking industry, where 80% of our goods move across the country, crosswinds, inundated roads, supply chain disruptions that occur because of weather, increasing wind shear risks. So although we haven't had planes falling out of the sky the way we did in the 80s, many of our weather delays around aviation are actually wind shear related. So you've got these multi-cell and supercell storms, which, by the way, between wildfire, flash flood, and severe convective storms, which is straight line wind, the industry has historically called those, the insurance industry has historically called those secondary perils, as opposed to hurricanes and earthquakes. Well, turns out these secondary perils in the last 10 years have been responsible for as much as 70% of insured losses. And so you're looking at things that have this kind of correlated systematic driver in terms of the change in climate, but they're manifesting themselves locally in these very complex ways that are actually really difficult to numerically simulate. Different data needs to be collected, different granularity, and much like financial markets, it's highly state dependent. So trying to do simulations of these kinds of events are really challenging. So what does that mean? I think that means we need to broaden our definition of stranded assets and broaden our definition of climate risk. It's not just about water inundation or infiltration of buildings somewhere in the future. It's about electricity grid instabilities like we saw in Texas last year. It's about straight line wind impairing everything from damage in agriculture through transportation. It's about flash flood inundating and resulting in water contamination around, urban and other water supplies, air quality issues. Many of these, by the way, have been highlighted by BlackRock as being a significant threat to the $4 trillion municipal bond market. BlackRock's been very vocal about this over the last year or so. There's more I could say here. We do need to collect different kinds of data. We need to focus more on not just, and my comments come from sort of 40 years in banking. I started in banking in the early 80s. I've worked structured credit, project finance, leverage finance. I worked for AIG and Swiss Re at the senior levels, looking across the portfolios, commercial insurance, alternative risk transfer. I worked at a rating agency rating insurance-linked securities. So my perspective, although heavily science-based, is also very applied. And I've also worked a lot in the court system. I think a lot of the regulatory response and the impact on cash flows and cost structures and the contingent liability threats are going to be led by force majeure litigation and contract and tort disputes, which then will result in an institutional response from regulators. And it's going to require, I think, the kind of stress testing currently being considered is necessary, but it may not be sufficient. And there's other analytics and other data and other things we will need to bring to bear. And in fact, some of these lessons can be observed in the current pandemic situation as to how that's evolving. A lot of those other things will show up: emergency response issues, which then result in other kinds of liabilities for municipalities. And then how does that relate to industrial players that share risk with municipalities or rural areas? I'll pause here and we can pick up some of those themes later.
Great, David. Thank you. Thanks. Pete, why don't you go ahead?
Super. Thank you very much. And I appreciate you having me join you today. So at CoreLogic, I think we have a bit of a point of view on climate-related financial risks, particularly with respect to single-family residential, multifamily residential, and commercial property as collateral of financial instruments. And that's what I wanted to remark on today, that I think we have a very strong point of view that if you want to understand climate-related financial risk, it starts with modeling the current physical risk profile to these properties reliably and accurately. And we view that as the table stakes that lets you do the type of scenario modeling we're discussing on this panel. So another way to put that is where is the puck today? Is to use that old Wayne Gretzky analogy, I believe. But it's, in our view, it starts with having the data, analytics, and models to be able to first model what is a composite risk of the 7 major natural hazard perils: earthquake, shaking, hurricane, wind-based hurricane, inland flood, riverine and flash flood, severe convective storms, hail, tornado, straight line wind, storm surge, wildfire, winter storms. Being able to model and score those risks, associate that with a probability of damage to a given property and its structures, and then to assess the reconstruction cost value associated with that damage, and then associate that based on the level of flood insurance and property insurance endorsements on those properties, what is the level of uninsured and underinsured losses to those structures? That's kind of your baseline and foundation to figure out where the puck is today. And you really need to focus on doing that reliably. And so we think about it as drivers of loss and drivers of accuracy in that, framing of the physical risk profile today. So drivers of loss would be elements such as the occupancy of the property, the year it was built, first floor elevation is crucial, the basement and its finishings, the number of stories, property location, and its valuation. Drivers of accuracy, there are many, including the data inputs, but among them would be the use of light detection and ranging, LiDAR technology, and the resolution associated with digital elevation modeling. So the better the resolution of your digital elevation modeling, DEM, the more accurate your assessment of the physical risk profile is going to be, particularly as you get into suburbs and more dense urban areas, because it really is about trying to be able to pinpoint not only where is the parcel and the structures associated with that parcel, but then understanding kind of the three-dimensional elements of where is the first floor height relative to sea level, ground level, and then that's a big function of being able to reliably estimate. So it's about really how do you know you're dealing with the property you think you're dealing with, and that's the big part of knowing where the puck is today. Then and only then, in our view, once you understand reliably the existing physical risk structure, can you start reliably modeling the effects of various climate change scenarios, i.e. where the puck is going. And that's, of course, what we ultimately want to know is where is the puck going? And so, for example, the UN Intergovernmental Panel on Climate Change, the IPCC, they have various models on CO2 emission levels, how that will modify weather patterns, sea level rise changes, et cetera. We view that more as a sensitivity analysis, that once you have that baseline of physical risk, reliable physical risk assessment, you can start modeling what different climate change scenarios look like, whether that's IPCC models, other models. And you can do it in the form of sensitivity analysis to start getting your mindset around what is the vector trajectories around how climate related financial risk is going to affect the collateral underlying my investments and my instruments. And I think the last I'd say is we think infrastructure is critical here. There's a lot of discussion around open source, commercial models. I think the way we look at it is it's not either or. It's a public-private partnership model. Having an infrastructure and platform that lets you easily combine the best of all worlds, that lets you take different commercial models, open source models, data sets, commercial, proprietary, open source, use them, model with them, compare them for accuracy. That is the infrastructure that's going to position institutions for success, financial institutions for success. And we are certainly seeing, one of my major roles at CoreLogic is public policy. And with the recent response to recently there are federal agency responses to Executive Order 14030, U.S. climate-related financial risk. And just without going through the litany of that, I'm sure most folks on the webinar are aware of these, and we can talk about them more. But there are a number of borrower disclosure related, investor disclosure related. So if you're in the business of lending, an FHA, VA, rural housing, purchasing Ginnie Mae MBS, same with Fannie Mae agency securities, Fannie Mae, Freddie Mac, credit risk transfers, investor disclosures for various financial instruments. There's going to be a number of borrower and investor disclosures getting to the heart of what are the flood and climate risks associated with these investments, which are based on these underlying single-family, multifamily, commercial collateral. And then, to what extent will there be kind of a push to integrate that into quantifying financial risk to guarantee books, and the gamut of loss mitigation programs, underwriting, pricing, and of course, balancing all of this against housing affordability, equity, and access to credit. So many, many policy issues coming down the pike. How the independent agencies, which are for the most part, these are independent agencies with the exception of HUD, how these independent agencies decide to move forward on these policy responses remains to be seen. But having that accurate infrastructure so that you can be responsive to these policy initiatives, I think, is what's critical. And I'll pause there.
Thanks, Pete. That's great. So now we have Chris joining us from Glasgow.
Thank you, and thank you all for joining. I will try to add something valuable after these very smart speakers spoke before me. I think, from my perspective, what we need to look at is to take the next step is to make sure that we have all of the assets that we just described. So whether they're homes, buildings, critical infrastructure, mapped to the ownership or security under which those are sort of tied, and then to identify risks to those pieces. What we've done historically at S&P and done quite well, and we think it's critical to sort of the functioning of the broader ecosystem, is to tie those assets to the underlying entities which own them, to get a broader view and a sense of what the exposure is for those entities. And as we think through from a lending perspective or from any other perspective, understanding what the broader exposure for your sort of counterparty is from a climate, from a physical and transition risk perspective is going to be critical as you think about the longer term stability and risk management for any loan book or any particular grouping of exposures. It's critical to have that asset level data and cross-referencing to make sure that we're all aligned. Additionally, we do need to have a variety of scenario analyses to understand how these different risks may play out. We need to make sure we have a few different factors, as we've highlighted a bit during discussion previously. We need to make sure we understand the baseline exposure. So it's critical to quantify the risk and the establishment of a baseline, which can then be tracked and sort of on the basis upon which those scenarios can be applied. We need to have sector-specific perspectives. We need to understand sort of in addition to GHG emissions, we need to understand how to think through the specific risk exposures and opportunities in given sectors. For example, technology deployment perspectives can be used to quantify the exposure of power and automotive sectors to the development of low carbon technologies such as renewables and electric vehicles. So it's not just simply looking at how can climate change damage the physical assets, but also how can it damage the business model and how can it provide additional opportunities for the business model. Similarly, we need to be thinking through forward-looking perspectives. Any modeling we consider needs to consider the future risks, obviously the different scenario analyses and the different opportunities to understand and mitigate and sort of adaptations. I think it provides a massive risk both for the financial sector and for corporations, but also is a gigantic opportunity for anyone that takes the lead and steps forward to play a significant role in the transition of the economy. For banks in particular, which play a pivotal role in financing the economy, there will be a massive opportunity to help the economy broadly adapt. As we think through scenario analyses and opportunities that banks may use in other areas, this spreads throughout a variety of different opportunity segments within the bank. So thinking through lending, thinking through capital markets, thinking through M&A advisory, all of these critical data points that we will need will support the continuing functioning of financial markets and continuing that support for the financial sector to keep the economy going. From our perspective, and I say this as someone who works within an ESG and climate organization, but is also generally passionate about this. We think the market is going to shift in a way that will be fundamental, and we all want to be ahead of that and need to assume that these changes are coming and need to be prepared for them. And we're excited that what I'm seeing at COP this week and what you're seeing in the broader ecosystem is a general sense for change. So it's very exciting. I'll pause there, but I can tell you in terms of a report from Glasgow, the attitude here is very upbeat. There's a lot of focus around making an impact, and it's pretty exciting to be involved in.
That's great, Chris. Thanks. And last but certainly not least, Hugh Conroy. I'm very interested in hearing from you the perspective of your clients.
Great, thanks, David, and thanks everybody for having me on the panel. Like as a bank regulatory lawyer, I come at this from the perspective of what are the regulators going to make the financial industry do? Like, what are they going to require of banks, either through guidance or regulation or merely supervisory pressure? And at the outset of this, we had Bridget say that, look, Michael Hsu at the Comptroller of the Currency said you can expect some guidance by the end of the year. Fed Governor Brainerd has said the same thing. The New York DFS, the Department of Financial Services, just last week announced that they have a climate risk division that will integrate climate risks into its supervision of their regulated entities. So there is something that the regulators are going to make the banks do. Now, a number of people on this call might say, well, that's not the right way to look at it. Why are we looking at why would banks wait to see what the regulators make them do? Isn't it good risk management or good for mitigating losses if they just do it on their own? And in my experience, I think the regulators tend to have a different view of what they want the regulated entities to do. So I do think that we need to understand the regulatory expectations in addition to already working on the types of things that my fellow panelists have mentioned, including scenario analysis and data collection, et cetera. When I look at this issue of what regulators might cause or require banks to do, let's just take as an assumption that they will require some form of scenario analysis. I think Brainerd has said it, the FSOC said it in their climate risk analysis a couple of weeks ago. So let's just take that as an assumption. If we take that as an assumption, then banks have two roles. They are consumers of data that feed into these models, and they are producers of data that feed out to the market and their own investors and the regulators. As a consumer of data, I think scenario analysis is going to have to address this sort of garbage in, garbage out problem, right? We're going to have to get reliable data into the models so that the regulators and the banks themselves can think that they've done the right thing. Now, is that going to be resolved by regulation? I don't know. The SEC disclosure regime that we're going to look forward to next year may tell you a little bit more about a particular client on an aggregated basis, but to some of my panelists' points, what about the asset level data? And it's very clear from the FSOC paper that was put out a couple of weeks ago that the regulators themselves indicated that they need the expertise and resources to analyze this. And if they think they need the expertise, then it becomes more clear to me that the regulators will require the banks to get their own expertise, to do more diligence that is not filled in by things like SEC or bank regulated disclosures. So then banks are producers of data. What does the output look like? Right? We have scenario analyses. It gives us a range of different possibilities. What does that range show? Does it show impact to capital? Does it get worked into stress tests? Can a bank that looks at a portfolio and looks at the losses in that portfolio take a wait and see approach? Does it have data that's different from the incoming data? So for example, does it know that the loans it made to a particular company or bank, I'm sorry, a particular company or industry are actually being used to mitigate climate risks as opposed to just continuing to finance, let's say, fossil fuels? And we already see groups like the Net Zero Bank Alliance saying to the regulators, look, we need a better idea of what good loans are and good data about portfolios, including transition finance, not just financing old stranded assets. And then what do the regulators do with those outputs? And we had the head of the European Central Bank, Andrea Enria, say last week, look, banks are asking me, is this going to result in more regulatory restrictions? And on the other side, he used those words, the other side, they want to see some blood spilling on the banks. But he said, no, the data is just data. I have to admit, I find that hard to believe. I think that the regulators will use that data to do something. And I'll leave you with just this point, that the FSOC paper in its recommendations said to its members, to the bank regulators, that they should be reviewing existing regulations, guidance, and regulatory reporting to see whether updates are necessary and evaluate whether additional regulations or guidance specific to climate-related risks are necessary. So I'll leave it there and see what other panelists want to say about all that.
Good. Let's open it up to just an open panel discussion, and maybe some of the panelists have questions about to some of the other panelists, or would like to continue to make a point. I do want to agree with what Hugh was saying. I think our clients are confused in terms of what regulatory regime will there be, who will be the regulatory body overseeing this, or will several bodies? So I think they're concerned about making an effort to collect data only to find that that's not the correct data, that's not the correct model that the regulators want to see. So I'll open it up to the panel.
I'll kick it off with a question to Peter. So Peter, I very much appreciated and resonate with the breadth and scope of data and models you talked about, and the fact that you got into things like LIDAR and DEM models. One of the things that colleagues of ours and us have noticed is there's not enough discussion about subterranean hazards in many cases. And the recent incident with the building collapse in Florida, for example, where some of the engineering is attributing it to salt intrusion, undermining the rebar structures on what we thought was a safe and reliable and secure foundation approach. And that others have said, we think there are a lot of other buildings in Florida subject to the same thing. Sea level rise and salt intrusion has been a risk that's been monitored to some degree since I was in college in the 80s. More in the Caribbean than here, but we're now starting to see some of that. And that's before you ever see water at the surface level, or before you see a lot of flooding of the kind you see in these scenarios. Could you say a little bit more about the importance of better hazard mapping below the surface, and how that affects infrastructure, and how that might affect real estate owned when some of these things go insolvent, lender liability issues, that kind of thing?
I appreciate the question. What I am going to say is that I'm not a scientist. So I think I personally start to quickly get out of my technical depth when we start getting into this level. But, just some general observations would be that we have to, this is where there's, this kind of balance between, kind of proprietary modeling and standards, right? I mean, just, what I feel like I'm hearing in there is like, is some level of standardization around engineering methods has proven to be very effective. I'm blanking on the specific standard right now, but for example, around earthquake risk and kind of modeling or assessing kind of the engineering standards around earthquake risk and particularly with multifamily and commercial structures and the approach that goes into the inspection. Like there's just certain kind of standards efforts that can provide some level of consistency that provides better integrity to the models. So I know that's not particularly specific to your question, but it just feels like there might be some discussion around how some of this under the ground modeling is better done, and our chief scientists would be that in our squad of science scientists at CoreLogic would be far better to speak to this than I can. But that's one thought that comes to mind, and that's where I'll kind of leave and see if any of my other colleagues have anything more technical they might want to add in there.
I actually have a question too, which sort of follows on in the same rough direction. It's very impressive how both you, Peter, and David have discussed the sort of the details of property valuation under a whole range of risks and scenarios. But one of the things that you didn't mention is how the market values these houses. It's like that's a relevant factor, but in fact, the market is maybe unaware of the analysis that you've done, but at least has some valuations implicit in it. And if we're asking how sensitive banks' portfolios are to changes that are happening, there's a question of how much does the market change its valuation in response to evidence? And the models that you've put together are saying that ultimately your evidence is a better way of evaluating the market. On the other hand, if you have 10 scenarios, what are investors supposed to do with these 10 scenarios? It gives 10 different market values for what the property is. So we're seeing some market valuations which might be consistent with one scenario rather than another. And when the NFGS says, you know, pick a scenario, are they telling all investors that this is the scenario and we should believe it 100% at this point and value the properties based on this scenario instead of that scenario? Well, that's a pretty complicated thing. And so that's the reason our view is that by looking at asset prices over time, we see how much investors are changing their viewpoints. And actually we see a big shift in the valuation of climate risks. And this is partly due to physical risks, but it's actually, I think, especially due to transition risks, which again are not going to be picked up by the kind of analyses you're talking about, or at least not very simply. I think that the exposure of the banks to climate is very heavily weighted by how the market views climate. If the market doesn't think climate is very important, then it looks like these risks aren't going to be there very big. But if then expectations change, and Glasgow might be an example of this, but hurricanes might be an example, then you get a sea change in valuations. And this is what could really expose banks to a great deal of capital risk.
So Rob, is that what you mean in your analysis, that investors are beginning to discount the value of these assets that might be exposed?
Right. We calculate a climate beta for each of the major banks in the US, UK, and actually around the world. And in almost all cases, these have increased very substantially over the last couple of years, which suggests that the market is more concerned about the health of banks that are exposed to climate risk. These betas seem to be correlated, and we've only done this a little bit. They seem to be correlated with publicly available information on the asset holdings of the banks, which kind of gives us a little bit of confidence that we're seeing a real phenomena rather than just sort of statistical. But I think this is a picture that changes the way we think about what we're trying to do with these stress tests.
And is that done through the Volatility and Risk Institute?
That's right. This is being done by the Volatility and Risk Institute with my two co-authors, Hugh, who's, as you mentioned, now at the Fed, and Dick Berner, who is former head of the OFR and co-director of the VRI.
Okay.
Rob, can I ask, are the regulators part of the quote unquote market perception, market valuation that you posit? And I ask because let's say the market looks at the price of bank stocks, as I think some of your studies do, and doesn't quite understand the climate risk, but regulators force the banks to do something. And we've had, let's say, Mark Carney, who used to be the Bank of England, is now the UN Special Envoy for Climate Action and Finance or something. He said last week, I think at COP, that we're going to start looking at banks' clients and how their transition plans are working. And those that are not moving forward with their transition plans will not find capital, because we're going to basically hinting that we're going to tell the banks to not fund them. So doesn't that have an effect on the valuation of an asset at an industry or at a fossil fuel company or something like that when the banks walk away? I mean, this becomes a loop, doesn't it?
Absolutely. I mean, asset prices respond to all policies as well as non-policy events. And so this would affect asset prices. Some people see that as a goal of financial regulation of climate change. And this is what the question you were asking earlier, is that really the ultimate target here is to get the banks to do what the fiscal authority seems unwilling to do, which is to price carbon. But that's not the only reason why this is interesting for regulators. Regulators are concerned about the financial health of individual banks for all kinds of risks, including climate risk. They're concerned about the health of the financial system. And if in fact many banks are exposed to the same shocks, and these shocks have a reasonable probability of occurring, then regulators have a macroprudential obligation to look at this. And so I think that you can think about stress testing from a macroprudential point of view as without saying that the goal is ultimately to change the price of climate assets. I'll tell you one other thing that I think of, which is to take your exact sort of example and turn it around and say, suppose we get a majority in Congress that says, okay, we're going to extend cap and trade to cover the country because that's what the economists think is a good idea. And economists and finance people, lots of people think it's a good idea. But the banks are too exposed to this. So the banks come and say, no, you can't do that because you're going to create a banking crisis because we have lots of fossil fuel investments that would be damaged by this kind of policy. Well, that's an outcome which I can imagine regulators want to forestall.
So Rob, this is one of the reasons I think it's so important to broaden or disaggregate the equity price signal and look at some of the other cost structures, electricity markets, credit default swaps, a lot of the things that could end up providing a sense of, through solvency and funding transmission channels, where the constraints are coming in. And that's also the reason I think tracking how contingent liabilities end up binding through litigation in case law, or whether it's a bankruptcy or whether it's some of these force majeure disputes, right? Or commodity prices of different kinds. You start to see demand surges, you start to see a lot of these other things that may be additionally informative to the equity price on its own and give more indication of where the valuation risks are. And I think among those we've seen this happen with asbestos, other environmental risks, and so forth. But I think, for example, folks, even in telecommunications, we're making enormous investments into 5G and sub-6. Well, although those wavelengths, those spectrum bands carry more information, and we're going to tie our V2V cars and our V2X, autonomous vehicles to that network, they're extremely susceptible to rain. You lose your transmission, it attenuates as there's rain. And so think about running massive transportation systems dependent on 5G connectivity with unpredictable local, dynamically changing rain scenarios, right? So there are these things that we need to start looking at that I think contribute to the aggregated equity price. But in order to do a decent job navigating around them, we need to incorporate credit markets, cost structures, different kinds of spreads like the spark spread, the dark spread, all of these spreads where we can start to disaggregate cost structure and understand how the transition risk may compound. And any thoughts on that, Rob or Peter? Because I think you have your hand up as well.
So, I mean, I think that's all around point. I'll just add to that just on all these themes. I mean, I think from our experience, we're definitely starting to see banks, investors, and guarantors really just on their own stress testing climate-related risks in terms of portfolio, assessing portfolio risks, portfolio pricing, and what's not clear is the extent to which that's making its way into market prices, right? And there's not a lot of we can't see any line of sight or transparency into how that is kind of bearing on market price equilibrium. And there's obviously not a disclosure regime at this point that would, help with that kind of like transparent price discovery. So just, I think there's this interesting question to, like all these themes we've been hearing from Chris and Hugh and Robert and yourself, David, that, the industry may start doing this, and, the modeling techniques they undertake, hopefully they're doing reliably. And that's a separate question from when regulators may start imposing, to Hugh's point, their own point of view on this. And to the extent that it's not consistent and has disclosure regimes associated with it, would be like, it's troubling to think about, and I hadn't really thought about to this panel, the degree to which we could see that kind of potential distortion in market prices occur. We need to really kind of try to get some alignment around that in some fashion. And, maybe that's, through a FICO score like method, right? It doesn't have to be any one model, but it's, we got 3 credit bureaus who all feed data into a FICO score, and, lenders for ages have taken all 3 and said, I'm going to take the middle of the 3, right? Or whatever policy they have. So it doesn't have to, again, it's back to not either or, but just trying to get some level of understanding around the modeling techniques that are being used already, where they might be heading, and making sure that, we get some kind of assessment of how it's all kind of bleeding into market pricing.
So Chris, why don't you jump in? I know you've got a statement, and then I think we should move to Bridget, because we're well past our discussion time. And Bridget, you probably have a few questions on your table there.
I'll be quick here. I think one of the other things we need to consider is just time horizon. I mean, as we look out into when we expect these climate impacts to occur and when we expect transition risks to occur, it's not unrealistic to assume that to some degree you're seeing increasing pricing simply because it is becoming more relevant or becoming more near term. At a certain point, the timeline between catastrophe modeling and climate modeling will align. And what you'll see are different scenarios in which we have to assume these things as more near-term risks, and thus the likelihood that you see them priced in, at least in my view, becomes a bit more realistic from an assumption perspective.
Thank you. Bridget, why don't you jump in?
Great. We've gotten a series of questions that sort of all, I'd say, cover kind of 2 issues. One, related to some comments Hugh initially made and others responded to, that I guess one way to think of it is, what's the difference between climate change stress tests and scenario analysis? Relatedly, and I guess what that's about is, the data. So scenario analysis is sort of providing data. None of us in our world have ever seen data that isn't used. So what is done with that? Is it sort of what some of you were positing, that the regulators, including US bank regulators, are going to move more into a, what critics would probably call credit allocation role? Or will it just be this intense focus on risk management that kind of gets you to the same place? And then relatedly is the data. I mean, there's 2 or 3 questions that have come in about what data should banks be using? Is there going to be any kind of standardization of this data to help them, model and prepare? So I don't know, maybe Hugh, we'll start with you and see what else others have to say.
Look, I think, notwithstanding my statements before about, and as you reiterated, Bridget, that we've never seen the regulators decide that they want to collect data and then not use it in some way, right? So it's going to end up being incorporated into some regulatory guidance, in my view. I think there's a time frame element to this, which occurs in two ways. Number one, that's one difference between scenario analysis and stress testing, right? The stress testing is a 9-quarter, at least the way it's currently structured, is only 9 quarters. Scenario analysis is, structured to go out to 2030, 2050, et cetera, over a course of different physical and transition risk scenarios. Now, that difference kind of works itself into another timing issue, which I think is, I think that the regulators are focused on scenario analysis now so that they can collect data. And I do believe that they are not in the short term going to require that data and the scenario analysis be worked into a stress test. But I do think that as they learn more, the medium to long term will result in this being incorporated into some sort of stress testing where it will have an impact on how much capital you have to retain. I'll pause there.
So, Rob, I'd be interested in your thoughts on this.
Yeah, so I think of scenario analysis as trying to figure out how exposed each entity is to some factors that you're well, to the counterfactual scenario that you formulate. Whereas stress testing really is a capital adequacy question. Is the bank adequately prepared for this? So the answers are obviously, because the bank could have a big investment portfolio in fossil fuels or coastal real estate, and yet have enough capital so that they can withstand the shocks. And so that's, it's a different part of the question. But I think that when you start doing stress testing out, scenario analysis out for 20, 30 years, you really have to ask the question, what does that affect? How does that affect the value of these assets today? And that has to do with whether everybody expects this counterfactual scenario. I mean, if the market really learns this counterfactual scenario, then asset prices will be impaired by this amount. But I don't know whether we can put probabilities on that kind of an outcome.
Well, and who knows if the models are correct, if they've got the right information, if they're covering the right issues. That's the issue that David's brought up, several times. We're saying we can model these risks, but can we?
So Dave, along those lines, one of the things that's missing from a lot of the discussion around data fusion, right? Trying to bring together data from different sources of different kinds and get them into one model, especially with these complex state-dependent phenomena that we're looking at, is there's not enough time or effort being spent relative to, say, if you look at the satellite imaging world or whatever, on uncertainty quantification, standard error reporting, robust confidence intervals where you've got a high dimensional data set. That it's not just about the point estimate. It's about the paths, and it's about how do you quantify and describe and diagnose uncertainty when you've got a multidimensional phenomena going on within some particular time scale and spatial scale. And we're going to need to get much more serious on that sort of stuff. It's like, what was it? Hitchhiker's Guide to the Galaxy. What's the answer? 42. What's the question? And it's, 42 what, right? So that's kind of my soundbite opinion on that point. So.
Yeah, I'll just add, if I can, really quick, that while I'd want scientists who know what they're talking about, other than myself, in the room for these discussions. We are seeing the seedlings of industry standardization efforts. In the mortgage industry, we got the Mortgage Industry Standards Maintenance Organization that has traditionally been a data standards bearer, but has evolved into policies, procedures, even model legislation and regulatory language, regulatory policy language, and Structured Finance Association is another really thoughtful trade group that does a lot of standardization work on behalf of its members, which includes everybody in the securitization ecosystem. These efforts, can start to kind of, widen the aperture around what is kind of the universe of inputs into these models that make for a model that has high integrity. And we can, in those forum, debate, where there's, elements, proprietary elements that perhaps, companies aren't comfortable standardizing, but if we can at least get our arms around that universe of, these are the components that make for a high integrity model. I'm sure we'll also find examples of inputs that do benefit from standardization, if not from a data definition, from a policy and procedure perspective. That could go a long way to solving some of these challenges.
Chris, can you jump in on this in terms of your thoughts about what S&P is doing in this regard in terms of the modeling and pulling the data together?
Sure. Well, I think as we move forward in the climate space, we are very much so in what I would call the early innings of adoption of some of these methodologies and use cases and factoring into models, as we've discussed earlier. These things will evolve. I think what we're trying to do is to make sure that we're developing the right tools and sensitivity analyses for our clients to understand and to factor in their decision-making processes. Our goal is to be, and I'm going to butcher this tagline, but we are trying to be the single source of sustainability intelligence. And within that, we need to make sure that we can give our clients the tools to factor in both physical and transition risk assumptions into their models and obviously longer term projections. So from our perspective, we like the idea of moving towards some degree of alignment around certain areas and obviously continuing to provide the types of solutions that our clients need to make the decisions that they need to make.
Thanks.
Another question. Oh, go ahead. I'm sorry, Rob.
We're just going to make an obvious and trivial point, which is a lot of times data collection really is not for the point for the regulators, but for the firm itself. And the regulators forcing them to gather their own data actually provides a lot of guidance to them that they wouldn't actually have done. Supposedly, that was one of the benefits of risk management in the first place. And it's great to hear that the industry is coalescing around ideas, and I think those will be influential with the regulators as to what they require from the rest of the industry.
Also, these data and analytics, Hugh and I were talking briefly last week, also is a potential source of strategic and competitive advantage for those who really start early and do it right. And we shouldn't just see this as some kind of impediment to something. We should really start to view this as an important resource for long run, sustainable, viability economically, right? Protecting economic capital and possibly growing economic capital by having better navigation.
We've also gotten some questions about what do you think is the prospects for there being alignment among the bank regulators globally versus, sort of the US going alone. This is a situation where we'd already be playing catch up, but kind of putting the timing piece of it aside, what's your sense of how likely this would be to have, sort of a Basel element to it, where there's a agreement, and then there might be individual sort of glossing or I don't know who wants to start out first on that, Chris.
Sure, I can jump in. It would certainly simplify things. I think the way that we're seeing things now is it's still a relatively fragmented landscape, at least based on what I've seen. The likelihood that it coalesces around one particular sort of framework or one particular view, it's still early days. I mean, obviously, if we follow certain pathways that we've seen of other types of risk management in other areas, you may expect to see some degree of coalescing. But I think there's still a lot of ground to cover before we get to a state where we have some degree of alignment across the different groups. There's also different from a regional perspective. There are different levels of adoption and awareness, both from a regulatory perspective and from the client engagement perspective. So I think my gut tells me, and this is not based on anything other than purely conjecture and what I've seen, but I think we're still a little bit in the early innings to start getting towards sort of a coalesced model. I don't know, Hugh, if you have a different perspective.
I think we are in early innings, although I just add two things to that. One is that, policy making in the US becomes subject to the political winds, unfortunately. And, you know, those political winds don't change just every 4 years, but they could change in midterm elections too. So, you know, the speed with which we make policy in the US versus policy elsewhere, I think is likely a factor here. I think one other thing is that this will likely be driven through risk management and capital, in my view, at least for the banking sector. How we deal with other sectors is a different story. The Basel Committee, I believe, is supposed to be in the next month or so coming out with a new paper where, unlike their earlier papers, which were like, what are the risks? How can we start thinking about this? This paper is supposed to say, how can we use the existing Basel capital regime and its elements to address climate risk now without changes? I think maybe I'm overstating that, but I think that's what it's supposed to say, and we'll see that soon.
We also need to be careful of, we need consistency, we need coherence, we need, you know, the right level of comprehensiveness. We have to be careful to not become myopic in our metrics, right? It's one thing we learned from the financial crisis is every bank on the planet is using the exact same VAR number for allocating funding. That creates its own set of unintended consequences. So there's a balance here we'll have to strike, I think.
That's a great point. I know we're at the top of the hour, so bottom of the hour, bottom of the half hour, whatever. I'll just mention, we got a lot of questions about timing. You know, when are the regulators, and I'm not going to ask those unless someone wants to raise their hand and say they know the answer as to when we'll see something. So I'll give you a minute for that. But I think one takeaway from this discussion is, you know, it is sort of the regulators are coming, but the market's coming faster. And so sort of how those two are going to interact, it's a really interesting, and I think you all did a great job of bringing that out. So thank you. You know, clearly we have enough questions and topics. We could probably do this once a week for the next year or 2 or 3. But thank you all for participating today. It was really a great discussion. There's so much more. We didn't even touch carbon offsets. I know there's a lot of interest in how that's going to play. Maybe that can be a part 2. The IIB really appreciates, again, Cushman and CoreLogic for arranging this. I'm going to thank you, Rob, Chris, Hugh, David, for your participation. And we look forward to talking again soon. And the recording is available to all the registered participants. I've received a couple questions about that too. Thank you all.
Thank you.
Thank you so much.